was like, Dad, go practice. You can't come inside.
You can't come to the PNC?
Yeah, I'll be excited to.
Is it?
Yeah, that's something. Brandon's got to play the intro video. Maybe not. Maybe we're not having.
I didn't do that, Chad. I didn't do that one.
Brandon, are you playing an intro?
Should we just rock and roll? Oh boy. 2024 is going to be solid. What?
Give me 1 second here.
Okay. Take a couple seconds with your deck.
Some technical.
This is my last bottle of the Lord, I think.
Shit. So I thought that the Live Tour and the Professional Golf Association Tour were already kind of in bed together. I'm interested but yet the Live Tour still wants to cut a big check to John Rahm, even though we don't know what the future looks like yet.
Because I think the idea there was that the 3-letter one was going to still exist even with the convergence and all that. Again, I don't know, but when somebody offers somebody 9 figures, do you blame them? Like, I don't care. By the way, if that means John Rahm's not in the Ryder Cup and doesn't beat the crap out of the United States again, I'm okay with that.
I hadn't thought about it that far, Mark. But JD, no, remember the money that started, the Saudi money that started the 3-letter tour. I don't even know what that stands for.
I don't know if that stands for anything. Yeah.
They are a primary investor now. Professional Golf Association.
It refers to the Roman numerals 54, the score if every hole on a par 72 course was birdied.
Welcome, everybody, to another episode of Retireholics.
Starting right on time.
You know how all the good episodes start, Roby?
On time.
When we spin the wheel of ice.
Justin, it's not going to you, buddy. It's all me. I can feel it.
No, it's all of us.
Okay.
Bob, entertain us. Tell us about it.
I don't have Smirnoff, so I'll do a Malort.
JD, chug the whole thing of Malort.
Yeah, I will. Bob, why don't you tell
hold on, Justin, hold on.
While we drink these, explain to everyone how Christmassy your Christmas house is right now.
So JD was telling me he's married to Mrs. Claus, and I explained to him that I was married to Grandma Claus, which is a whole nother level of Christmas decoration, interior, exterior, the whole 9 yards. It is over the top. Wonderful.
Oh, God.
What does your electric bill go up to for this month? Is it outrageous?
We have to tap into our 401k a little bit more. Yeah.
For the first, headlines. Brandon, headlines, please. Let's go. It's been a little while since we've talked about the old crypto, the old digital assets. 401k Specialist magazine has an article titled 2024 likely to see rise in Bitcoin allocation to retirement accounts. There's a little study that they did. I want to kind of set the stage for y'all, and then I want to get your opinion on Bitcoin again, because things have changed a bit. News alert, Bitcoin has crushed it in 2023. It's up, its return year to date is north of 160%. Okay. There is also big news in the Bitcoin digital assets world, because apparently this is Securities and Exchange Commission is very close to pulling the trigger on approving a Bitcoin spot exchange traded fund, which, so to kind of give you clarity, or everyone listening in on that, would mean people would no longer have to buy Bitcoin from companies like Sam Bankman-Fried's, I'll drink for this, FTX, or Binance. I don't know if you saw recent Binance information or news on the chief executive officer and founder of Binance getting busted for letting their platform be used by terrorists for, you know, trading Bitcoin and stuff. These are all not good things. Hang on. Oh God. And my son and I use Coinbase to buy digital assets. And to be honest with you, it's a pain in the butt. Like, it's really weird to go on to Coinbase and set up an account and make trades. So if you get this exchange traded fund in the future, regular folk will be able to go to like Fidelity, Schwab, Electronic Trade. I don't know if that's what it is, but, and they can purchase this exchange traded fund and invest in Bitcoin. There are many smart people who think that's going to be a massive tailwind for the adoption of Bitcoin. And we could see this price just continue to skyrocket. But I will ask it's not the $1 million question. I will ask the million Bitcoin question to the group. Once again, what, in your opinion, is the main reason why the industry pushes back against Bitcoin being allowed to be used in a 401k? We'll go to you first, Bob. Like, what's the problem here?
Oh, I think it's the typical one. Most people don't understand what it is, how it works, where's the value, what does it mean? I mean, you know, I'm in Omaha. Charlie Munger and Warren Buffett have famously, you know, bashed.
Rest in peace. Rest in peace. Pour out some beer on the ground.
And I think that's part of it. I also think, you know, that anytime you see a lot of hype around something, some people can get nervous about that. And it's not the normal institutional, you know, record kept, you know, tracked.
But here you go, Bob. Now it will be. And let's not forget that currently, we all know, just to remind y'all, Fidelity offers it in a 401k plan. Fidelity calls it their digital assets account, and it's record kept and, you know, custodied by Fidelity. That was my whole point with not having to worry about, I'll drink again, FTX, Coinbase, Binance. Now this is going to be big, well-known Wall Street financial services companies allowing you to purchase these types of assets. Chad, let me go to you in terms of, I think another big argument that you've brought up in the past is volatility, right? Like, I think a lot of people say, oh, we can't have Bitcoin in a 401k plan because it's too unpredictable, like it's too volatile. Is that something that you think is true?
No, I don't think that's a reason why you shouldn't have it as an offering. Do I think that certain people should not be, certain investors, certain folks of certain age, certain people who can't take that kind of risk on, should steer away from cryptocurrency? Yes. Do I think for others that they could use it as a sliver? Like, what's Fidelity? 5% you can have in your core fund in there? Why not? I think that that's a good opportunity for folks.
It's funny, everyone talks about how sketchy it seems, but let's remind ourselves, like, it had major news issues with Sam Bankman-Fried and other things. The price fell down to like, what, 16,000 and something at a certain point from a high of 60K. My point being, from a positive standpoint, it has weathered all these things. And it's been around for a little while now. To me, it's showing that it's pretty impenetrable. Like, it manages to keep chugging along and is having a great year in 2023. I also, the whole volatility thing, we're totally okay with plan sponsors allowing their participants to have their money in Facebook or Meta. We're okay. If I've told you, can you have it in Google? You would say, sure, you can put a portion of your assets into Google or Facebook or JP Morgan Chase. That's probably someone's name. And I challenge you all, go look at those stocks over the last 5 years and tell me if they're not more volatile than Bitcoin has been, because they're going to look very similar. And so I think that's also kind of a bullshit argument, the volatility. Like we've always allowed for volatile assets.
I know that the 401k Specialist magazine article was essentially polling of people who are already interested. Like there's a reason they're on Uncharted, right? Like of course those statistics are going to be higher than one would expect. But in the 401k space in general, I think that what you're going to find is if there's a way for record keepers to monetize it, and that might mean like what Fidelity did, which is saying we want to be first to market, early adopters. We're going to get people to come to us because we're offering this. But at some point, I think there's going to be a way where some of these record keepers are going to be willing to take some risk in their float income, and they're going to start investing in it, and they're going to start creating spreads on it. And I think at that point, when they can start to monetize offering it, we're going to see more and more record keepers get in the space. The problem is right now, it's difficult. They're not prepared for it, and they can't monetize it. Once that changes, you're going to see them jump in.
Good old For Us All is still in business. And if you go to their website, they make the statement that 46% of younger workers, this is not like you said, Chad, like people that are already in crypto, just in general, 46% of younger workers want access to cryptocurrency in their retirement plan. Do we ever, I'll go to you on this, Bob, like, and I want to kind of then tackle like diversity and asset allocation. Do we ever hear participants say or demand, hey, can we get emerging markets in here? Or I'd really like small cap value. Like you never hear that, but they're actually saying, geez, I'd really like this cryptocurrency as part of my investment. And lastly, Bob, and then take it away. Don't we believe in diversity in this industry? Don't we think it's smart to put our eggs in different, not all in one basket, and spread them out? And would not something like crypto be a nice little something different to add to the portfolio?
Yeah, I think from a long-term perspective and certainly from a diversification standpoint, there may be a place for it. The thing that makes it challenging in the retirement space is I vividly remember when I was an advisor, having plan participants come and say, I want a gold fund, I want a technology fund, I want a sector fund.
Specialty asset classes.
Yeah. So I want one of these in the plan because that's where all the money's being made. And this was, people who I tell the story, we had a printing company. They ran 3 shifts and we noticed a lot of money moving into this really high risk fund. Come to find out, the investment expert at the company worked on the 3rd overnight shift at the printing company, was telling all of his buddies, this is where you should put all your money. And they all were. Right. So that's what you have to protect against is as part of a portfolio for an educated investor, they should certainly have access to it. But just opening it up to, anybody with, whatever.
Yeah, that's a great analogy because we didn't limit people in terms of how much they could put into the tech mutual fund or the real estate mutual fund or the diversified emerging markets. And so if some idiot wanted to put 100% of their money in there, yeah, I did too for a little bit, bro. I had 100% in tech for a good ride. Then they could do that. But clearly with something like crypto or Bitcoin, it looks like we're going to put limits on it. So it's almost more prudent.
Can I throw a I don't think it's a tinfoil hat or anything, but just a random thought out into the universe about this. There's a lot of pushback. Obviously, it comes from a number of sources, but what is every fund company trying to do? Right? Get on a core lineup.
Assets. Yeah, get on a lineup, gather assets. No, did Mark freeze?
Mark
froze. He did.
Oh no.
I thought he
was
making a point.
He's making a great point.
Is that enough?
I think I get where he's
never gonna get on a core menu.
I think I get where he's going with that is the industry as a whole will oh, you're back.
There he is.
Oh,
Fix your Wi-Fi.
Mother of pearl. I don't know where I left off at, but
start from the beginning.
No. So yeah, these fund companies want their funds in the core menu, and having another asset class or another investment option come in pushes somebody out, pushes less assets into their funds, and creates more consolidation in terms of what's available. So could there be some negative stuff going out, whether that be marketing or materials or whatever, that's being targeted and maybe written by people behind the scenes that have a vested interest in these other fund companies?
100%. The industry as a whole, always put on your glasses so you can see properly here, or see clearly. There's a motivation for them to talk shit on Bitcoin because they don't have it, they don't sell it, and to Mark's point, it takes up some of the pie. I mean, 5% is a big chunk if we use that number from Fidelity. So yeah, that's a good point, Mark.
Yeah, 5% might not be a lot for a small plan, but 5% is a lot for the trillions that are at stake.
Yeah.
5% of the 46% young dummies, says the chat bar. I saw those earlier. Well, anyways, I just say, as usual on this show, if you're a retirement plan professional, don't bury your head in the sand on this stuff. It's clearly something that the general public is very aware of. And I hate to say it, but let's say the truth, right, Chad? When this thing goes from a low of 16 and reaches its high of 60 and goes north of that, watch out. We're back to the hustle where everyone's want to get into this thing, whether right or wrong. And I know we have to act in the best interest of our participants, and we have to help people with their fiduciary responsibility. But come on, allocating a small percentage to something that's so big in the news, such a big part of our life. I would like to see our industry start to open up their fucking boomer brains a little bit with this stuff, because I see a lot of negativity.
What is okay, boomer?
My issue, and we can move on from this, but almost every person that, and I know DeCenso's different, I was giving him some heat in the chat bar, but almost every person that argues against not having it available really has no understanding of cryptocurrency at its core and blockchain technology and what they're trying to do, especially in financial services. And so when they just say that it's not an appropriate investment, but they don't understand what the investment is built off of, it's frustrating. So I get it, it's not here yet, but just like you would research Secure 2.0 when it passed, like you're trying to do what's right for your client, spend a little bit of time, do some research, understand what cryptocurrency actually is and what it's built off of, so that you can then make an informed decision whether you want it to be part of your strategy moving forward or not. But just the straight up denial of nope, shouldn't be in a plan, it's too volatile, that's not the best argument. That's not a good enough argument.
Yeah, I agree. And hey, Fidelity is no reckless surfer from San Diego. They're a large, well-established financial services firm who has clearly placed a big bet on the future of digital currency. And so I'm not saying if Fidelity jumps off a cliff, we all chase them over the cliff, but you know, it's something, you know, it's something. So I'm with Chad. Keep your eyes open to it. Justin, I don't know if you're ready for this, but let's caution to the wind, bro. I'm just going to throw it at you. Like, this is the time of the show where you're going to introduce the guest, and you all out there are going to rate Justin on a scale of 0 to 10. So take it away, Justin.
I want to be honest with you. I was golfing all day and got home a little too late to write an intro. But for those of you who weren't here before 5 minutes before the show, got a little nugget for you. Our guest today has never had a beer and never had coffee. Nor has he had coffee in his beer. He's the king of Bitcoin, Chad's wet dream, SPS left-hand man, the president of Fiduciary Advocates, Mr. Bob Foster.
Wow.
That might be your best intro ever.
Intro I've ever had.
Yeah, that was actually, considering I was off the cuff, I have to give that a 10 myself.
That's pretty good.
That was very well done. Bob, welcome to the show.
That more often.
I want everyone to know that's listening out there, when I met Bob and got to talk to him, and I got to learn more about kind of his history, and he was a one-time successful advisor who basically just sold his shop and you know, I won't say retired because he's got another gig going on now, but he is a true retirement plan advisor that lives, breathes, and sleeps this stuff for the past few decades. And I was like, oh, after a few conversations with him, I knew he'd be a phenomenal guest. So I think we can really get into it today. So it should be good. Let's go to another headline that's going to seem a little nerdy to everyone, a little third-party administrator, but I think it's super relevant right now with Secure 2.0 and this long-term part-time employee rules and the American Retirement Association. So basically, they hit us with this rule. We all started kind of trying to prepare as an industry, but we still needed some clarity on a lot of the rules. Like when the nerds got into it, the Fred Riches and the Thomas Clarks and these people, they found a lot of like missing pieces and kind of broken bridges and things that didn't really work right. And so we needed some clarity on it. And well, they were so nice. The government gave us clarity literally like a few weeks ago. And so once we got that clarity, we looked at it as an industry and we're like, okay, wait a second. Like, this is intense. Like, this is a big deal. And we've only got 25 days until it becomes effective, and not just any 25 days, might I add. And this isn't referenced in this article, but the 25 days in fucking December. Like, this is like holiday time. Like, people kind of slack off here a little bit and don't go to work as much as they usually do. And
heck yeah. I mean, no.
JD.
And so it's not the best 25 days ever. Well, the American Retirement Association reaches back out and says, hey, man, they wrote a letter and said, look, we are acutely aware of the difficult position our members and their clients find themselves in due to this timing of this guidance. This is from Kelsey Mayo, who has been a guest on this show. We hope that this request will bring the matter to the Internal Revenue Service's attention, and they will take prompt action. Further down in this article, it says immediate administrative transition relief from the long-term part-time employee rules is essential. So it's basically the industry speaking on behalf of the industry and their clients saying, we can't possibly be ready for this thing on January 1st. Chad, I'm going to go to you from a nerdy standpoint. I know we looked at this internally and have some internal meetings about how are we going to educate our clients on this? How are we going to support them in this? And you come to a lot of difficult kind of impasses. In this new guidance on it, I saw some things that really weirded me out. There's vesting rules, so that are going to force plan sponsors to basically kind of vest people in two different categories, so the long-term part-time employees will vest based on 500 hours, and then the regular employees will vest based on 1,000 hours. And without
even
getting
if they kick over to a regular participant, they still vest moving forward at 500 hours.
And so the point being, like, the software systems that we use as administrators don't really kind of track that or allow for that. The record keepers have to rebuild their systems to deal with that. Plan sponsors are surely going to fuck that up.
Payroll providers are going to have to create the
payroll providers
appropriate way of tracking this stuff to help clients.
So that was a big issue. I even saw another one that freaked me out, where the assessment was that if you have dual eligibility in a safe harbor plan, and you somehow you would retain like your ADP status, but you might become vulnerable to a top heavy test, which I almost lost my shit when I read that. Like, so go ahead, Jen.
Well, you're exempt from top heavy testing coverage, actual deferral percentage, you're exempt from all those essentially. But what I think you're referencing is there's a lot of talk of how to avoid long-term part-time rules. And so you adjust the eligibility and say deferrals, everybody's eligible immediately, but safe harbor, it's 1 year, 1,000 hours.
This is the situation.
And now when you go this route, if you end up making a profit sharing contribution, you're back to being subject to top heavy.
Right.
And now because those people aren't in the plan as long-term part-time, they're in the plan because the eligibility on deferrals was less restrictive. Now you have top heavy issues and you got to give them contributions.
Bob, let me have you kind of speak on behalf of financial advisors across the country. I mean, I think a lot of you rely on your partners, TPAs, record keepers, to make sure that all these rules are followed properly. Does that concern you and all the advisors that you're speaking for, that we're worried about this shit, that we don't feel like it's going to be
Yeah, but-
executed properly?
Yeah. So two things. One, I would look at the administrator and the record keeper and go, okay, you guys got to figure this shit out because I have no idea what to do with that. And it's just one more intricacy that makes an already complicated situation even more complicated.
Right.
And naturally, all of us are looking at this from the perspective of how the hell do we do this as plan sponsors and administrative professionals? But look at it from the participant standpoint. You get a lot of people out there who've never been eligible for anything, and suddenly people are coming to them going, "Hey, you're eligible for the retirement plan, and this is really complicated, and it's kind of a pain in the ass for your employer." What usually happens to people who are in those types of positions when their employer gets pissed off that position is now more complicated? I can tell you when the health benefits came out, there were a lot of employers who went from 40 hours to you can't work more than 30. And if you do, we're going to, we won't fire you because that's illegal, but you're not going to have a job anymore. So I'm sure there's a lot of participants going, wait a minute, I don't, this to me is, it's great in theory and it's wonderful for that one or two people that it might affect positively. But there's a whole lot of collateral damage here that nobody ever thought about.
Let's talk about where it goes wrong a little bit. Because I saw Webby made a comment on the LinkedIn post. Is Webby here? I don't know. He made a comment that the Internal Revenue Service says good faith compliance is okay, meaning basically like, look, and I heard Fred Reese say something similar to this, where the government's going to understand that people are going to fuck this up, people being plan sponsors, and they're going to be less kind of stringent on them or less forceful on them. But then I simultaneously see an article from the American Retirement Association and the very same Kelsey Mayo, who's been on the show, and she's explaining how plan sponsors can legally fix their own mistakes. So if they don't let these long-term part-time employees in when they should, they've got this little 3-month window where no harm, no foul. But if they go beyond that 3-month window, just like in the regular 401k side, when you don't put someone in when you're supposed to, there's rules where the employer has to now put in the money on behalf of the participant. So I'm hearing two things out there like, oh, don't worry, the government's kind of chill. But then our National Lobbyist Association is saying, no, this is how you fix it. I don't know which one to believe, I'm going to, no offense, Webby, I'm going to stick with the American Retirement Association and Kelsey Mayo. So plan sponsors are going to fuck this up. We know this to be true. And the ramifications of that to me are serious. Like they will have problems. It's got to freak you out.
Leniency. Why don't they just give us a little bit longer runway to get it all set up and
well, that's what we're
asking. No point in keeping 1.0 implemented when 2.0 adjusted it. Like teaching people to do this for a 2-year period and then moving it, or 3-year moving it to 2. Like it just doesn't make sense. But there could have been a lot of things, right? Why for just the people between 500 and 99 for deferrals? Just make it for everybody. So go ahead and make
like a 403B plan.
Yeah, make universal availability for deferrals, or make no actual deferral percentage test for the first year.
Or just keep it simple.
Make some changes.
If you have 500 hours, you get to defer, and that's it. You don't go into testing. Okay. You're not even considered for coverage.
Or Chad and Justin.
How about the government just sets up a national part-time retirement program, so all of those part-timers just get assigned to that?
You mean like an individual retirement account that's available to all of them?
Chad, Mark, Justin, I got a news flash for you. Those things you just suggested are not reality. That's not what's happening. What's happening is what's in front of us, and they're not going to change it. And so those are great little ideas, but we have to deal with the reality of what is already come down the pipeline. You don't
think there's any chance they punt 1.0?
That's what I want to
take effect in 2024.
I won't. First of all, I will not get started on the 1.0 versus 2.0 as it relates to the long-term part-time employees, because that was fucking idiocracy. Like
I don't think they had any idea they did it until after the fact. And like, well, can't go back on this now. We'd look really stupid if we did.
That was so dumb. I can't even tell you how dumb that was. But beyond that, I want to know from you guys, what's the over-under? And maybe that's not the right thing. That's like point total. But like, what is the probability that we hear back from the Internal Revenue Service in the letter that we're looking at here in this article, and they actually do delay this. Like, what's your guess,
By
Bob?
the way, couldn't they have sent an email versus a letter?
Probably, Mark. That's classic red guy. Bob, do you think they're actually going to respond and say, oh, we're going to give you guys another year or something?
I think they'll respond after the deadline, and they'll give everyone some kind of a grace period.
After the deadline.
Oh, interesting.
Keep them
That'll be
guessing.
interesting.
Yeah.
Then you
Never
go,
let them know your next move.
hey, then you go to Tom, who worked 500 hours in the last 3 years on January 2nd. You're like, Tom, you're in, bro. Like, you can go ahead and defer. And then you're going to reach out to him 2 weeks later and go, oh, Tom, sorry, bro. Taking that back, man.
I laughed, JD. I laughed. I was given a presentation on long-term part-time this past week, and we were talking about carve-outs and exclusions. This was after our conversation, Justin, Mark, and I made the example of, okay, so you exclude a division of your company from the plan in its entirety, and you're passing coverage, so it's okay. But what we're reading is that the long-term part-time cannot be part of the exclusion in terms of their access to deferral. So imagine you're in a division and you're excluded. The whole division's excluded, and you're rolling around working 600 hours. Well, all these other people have been there for years, and you're like, yeah, I get to participate. I'm in. They can't keep me out of this thing. Well, all the other full-time people don't get access, but you get access because you're between 500 and 999 hours.
Well, okay. I was reading some of the chat bar, but the exclusions still apply.
The exclusions apply to your plan access, not to the long-term part-time laws.
No, I challenge you on that.
Dude, I already have it in an ASPA. Oh, dang it.
No.
Presentation, JD.
No.
And if
that
you
was
do,
one
JD,
of the,
you lose your safe harbor.
That was one of the things that came back was if you had a exclusion like the warehouse down on Main Street or whatever, you could still exclude them from even the long-term part-time. I'm putting my reputation on the line right here. Let's go, chat bar, chime in. I think these guys are wrong and I'm right.
That one then, because I don't think you're right.
We'll see. We'll find out. And in 2 weeks when we have Preston Rutledge on the show for our Christmas special, we'll find out who was right. Yes, I entered the reputation era. Is that a Taylor Swift comment? Very nice. Let's move on to another headline.
We're still on headlines. Okay.
Oh, yeah, that's what we do now. They're all
the entire
headlines.
show's headlines.
Yeah, it's all headlines.
I want to hear what Bob has to say. So
got to stay with it. Well, let's see what Bob says about John Sullivan of once 401k Specialist magazine fame, now American Retirement Association, also known as Brian Graff's little bitch, wrote this article.
Jesus.
I love Sully. You know, friends can say things like that. This article is
Fantastic.
Beware of false prophets. He takes a juicy slam at the rich dad, poor dad guy, and attacks 401k plans. Bob, I'm going to go to you first. One of the things he attacked is the cost.
Mm-hmm.
He said, hey, 401k plans have high fees. Is there some truth in this? And how do you respond when someone says 401k plans are expensive? Samson?
I stopped trying to figure out when people like this make comments like that, where they're coming from. I can't explain stupid. I mean, what's the alternative? That we're going to have no cost. I mean, we've seen no cost investment accounts. Nobody's in them other than the couple people at Vanguard. I mean, people have jobs to do. There are expenses to have that done. And I love the people that are, I don't know, just trying to create headlines, but the Susie Ormans and the Dave Ramseys of the world who are out there, preaching, and they make these wildly bombastic statements to get people riled up when there really isn't anything to get riled up about.
It's more like clickbait, maybe.
There have been historical challenges in some cases, but there's also, there's challenges with, the stuff that they're selling. It's an uninformed statement at best.
Well, let me try to defend it a little bit, and we'll see what you guys think about this. And anyone in the chat bar, have you ever had this experience? I have, where you're at an enrollment meeting and someone in the audience, one of the participants, stands up and says, hey, how come in my individual retail accounts, I can buy a Standard & Poor's 500 index fund for 5 basis points, but I'm looking at this John Hancock menu of investment options here in my $1 million 401k plan, and the Standard & Poor's 500 index is 80 basis points. What's the rub? This is bullshit. And he says it in front of everyone in the room. And how do you answer that question, Chad? Like, how do you defend that, or how do you answer that person? He's asking you a question.
Yeah, there's a discuss. Sorry, were you asking Bob or me?
I'm asking you now, Chad.
Okay. There's got to be a discussion around the fact that this is a qualified plan being offered by the employer that has services and legal obligations and filing requirements and costs associated with the plan itself.
Yeah,
And
but Chad,
costs,
can't my employer just pay for that, Bob? Like, why? Because my point is, Rich Dad Poor Dad's not totally wrong here. Like, it does have a higher cost.
Wrong, but you're right, JD, and that would have been, if you read deeper, like that is the argument, which is if you're not actually getting value personally from the investment advisor, and you don't, and the employer is forcing any compliance or admin costs onto you, like, then why? Why is there discrepancy? It's not in their best interest. And so I get the thought there. They're not getting value from those things. So why should they have to pay a cost for it?
But I would also say, because I've been asked those exact questions in a meeting, and it is uncomfortable if those fees are excessively high. I mean, yes, if you've got a knowledgeable investor who knows a good S&P 500 index fund should be, less than 15 basis points, certainly, and probably less than 10, then,
What did he say?
Standards and Poor's.
Oh,
so
you
there's
just
another
did
one.
it again,
but
Bob.
at the same time, can the employer pay it? The employer has to look at it and say, we have the total cost of the plan. It's the match and whatever you want us to pay from the administrative costs. So if you want us to pay the administrative costs, we'll do that. But then we're going to have to reduce the match. It's all about the budget. And then that's an argument with the employer. Are there benefits in line with everybody else? But there, to try and defend it or to tell them that they're wrong, you don't want to do that. They're right. It is more expensive than if you went to Vanguard and opened up a direct account and put your money in there. But that's an individual account that has no record keeping requirements, has no matching funds, has nothing else. And you've got to look at it as an investor and decide which one's better.
Right. And you nailed it with the match. I'm sure if the match is there, you have a solid defense of the slightly higher fee. And then, I would love for plan sponsors to pick up a bigger part of those fees sometimes. Because Chad, you mentioned that it was the advisor cost, but it's not just the advisor cost. It's all the hassles of the record keeping and the ERISA rules they need to follow and things of that nature,
Well, yeah, and I think you guys know that from an employee standpoint, the perception of them taking on some cost carries very little value to them, right? They would much rather see a match than the employer pay the administrative expenses. So like when I talk with businesses, I try to always encourage them to take on the expenses because that's a deduction and that's a lot of what we do. But usually they're weighing the benefits here. Like, do I give a match or do I take on more compliance costs? For sure, you give a match. It's received so much better.
Let's put Bob on the spot again and more because if there's like young or rookie advisors out there, they could learn from like how Bob might respond to some of these types of questions. The other thing that Rich Dad Poor Dad accuses a 401k of is poor investment options. Like and
Bitcoin.
and so like you have a limited availability of certain funds, and these funds are proprietary funds that are force fed to you. Like, is that really true of a 401k plan?
Well, I think it's there's always going to be somebody that thinks it could be or should be better. In some cases, it could be. When I was an advisor, we always built portfolios that had a broad range of investment options. You covered all the major asset categories. Maybe you didn't have a Bitcoin or a specific gold fund, but you gave them a broad array of investments to choose from. then you can have the discussion of, are these other asset classes worthwhile? And if you've got somebody who's that sophisticated, well, then, maybe you have a one-off conversation with them. But the average participant is not going to understand that. Put them in a target date fund and leave them alone. They don't want to know about this stuff. And so it's a little bit disingenuous when you say, they don't have a good set of options, or when a participant said, oh, our fund is terrible, I lost money last year, or our fund is great because I made money last year, not having any perspective on, everybody else.
That's the market. That's the market, not the fund, right? That's
exactly.
the asset.
Or, a different example, but one of my kids recently became eligible for health insurance at work. And he's like, I want to stay on the plan that I'm on, which is through one of our companies. And I don't want to use theirs because everybody tells me it's terrible. I'm like, listen, everybody doesn't understand their benefits. They have no idea. I said, go talk to HR, talk to the benefits person. And when he's like, this is actually really good. So it's am I talking too much?
No, not wrap it up. Ring him up. He said human resources.
Mark is frozen.
He said the acronym drink. Oh, Mark's frozen.
Oh, I'm sorry.
Frozen.
That's great. Well,
no, I don't. I believe that most 401k plans, especially if they have a qualified advisor on them, has a really good portfolio of some of the best funds in the market at the lowest possible cost.
Yeah, I agree with you. I don't. Go ahead.
I've got to argue for 1 second in that. In terms of the core menu investments, I see such tiny variance nowadays. Back in the day when share class was an issue, when most platforms had thousands of funds to choose from, like, yeah, I did see some work. Now I see 85% passive in almost all of them.
Oh, seen a lot of
almost always Dimensional and Vanguard, and then there's maybe a couple of active.
That's the race
and
to
a
the
target
bottom.
date. Target dates vary, obviously, but Bob, it's being commoditized. Investments are most certainly being commoditized.
I would agree
in the
with
last
that 100%.
3 or 4 years.
That's a good point, Chad. But that's an entirely different argument of like active versus passive. Even if you give me a passive menu, I still have got all these different asset classes to kind of play with. And I agree with Bob's point. I think this is where Rich Dad Poor Dad is totally wrong. I think most 401k plans, and even if they're not set up that way, they have the option to be set up that way. Like if the plan sponsor wanted to have a rock star lineup of mutual funds, like they could choose from all kinds of stuff and create that. It's always just that nerdy investor who's like, oh, where's my technology fund, or where, like you said, where's my natural resources fund, or this or that. And these specialty asset classes, for any advisors out there learning, maybe they're not the most appropriate asset class to have in a 401k plan. I mean, that's up for debate, but yes, Bob.
And the other thing you got to recognize, I mean, 15, 20 years ago, everybody's coming in like, why do I have all these expensive funds? I want nothing but I want an S&P 500 fund.
You almost had a check swing.
You have
said it twice.
I just want one index fund. And I mean, if you look at the requirements, it's one stock fund, one bond fund, and one cash fund. So that's all you have to have in a plan. So anything else is just fluff. Somewhere in between, you got a bunch of scared fiduciaries trying to figure out what in the hell should I offer to my participants, and that ranges wildly.
Well, and we do see some lawsuits that are backed by those types of accusations where these days, which I think is a whole nother bag of worms there, but okay, we'll move on. Let's have a little fun before.
So shut up and sign the fucking form.
Brandon's so good.
Do you have a pen?
That's how we should run 401k plans. Let's see if we can pat our wallets a little bit. Let's learn from the genius investment mind that is Robe Guy.
Oh my God.
You think
Yep.
Bitcoin's had great returns? Take a look, tap into your little stock app on your phone and look up Robe Guy's portfolio. That shit's been blowing the fuck up. And I mean in a positive way, not a negative way. when he tells you to buy something, you need to listen. Is he gone? Is he really gone?
Hey,
He's
JD,
really
when he
gone.
gets back in here, act like you just completed what stock we're talking about, and then make him answer with reasoning without
Oh,
actually
that's a
knowing
good
what
call.
it is.
Okay.
That's a great
Well,
call.
what I want him to look at today is ticker. I'll drink. This doesn't GME. Do I drink for a ticker? No.
No, I don't think you need to.
Do you know what
Well-
stock that is?
I just looked it up, so now I do.
GameStop?
Yeah, GameStop. And GameStop, not to be a 52-year-old that doesn't know of such things. Does this still exist? You go in and like buy video games and like Xboxes and shit?
You know, I just went into the mall. Like I haven't been in there for years, and that was like the only thing running was a video game store. It's the only thing that had people in it.
Justin, you play video games
Yeah.
from time to time?
Me and Chad were up till way too late
Oh,
last night, pounding
let's-
some kids, man. It was
Let's
great.
hear from the experts then. Is GameStop a good business?
No, not at
That
all. I
doesn't
mean,
mean it's not a good stock.
All right, Roby. The stock is GME. Name of the company is GameStop. It reached a
Are they
high.
still in business?
It's
I
a
was
great
shocked to
question.
hear.
Yes, they are. They reached a high of like just south of 60 for their share price back when they this was one of the To the Moons, right? This is when the youth of the world got behind it and pushed it all the way up for various reasons. It has since fallen back to today. It closed at $16.36.
Okay, all right. Okay.
It has a fairly new chief executive officer that kind of, I think, went in and like cut a bunch of people. He pulled an Elon Musk and went there and like fired a bunch of people and kind of got skinny on the overhead. And then like,
Yeah, but
usually
do
tell us
those
about the
kind
business.
of do those kind of stores really need? I mean, I honestly, I'm
Oh,
there we go.
Jeez.
fucking rum guy.
He pays
gotta
for
be on
better
the-
internet too.
He's got to be on the wrong Wi-Fi.
What an idiot. All right. Well,
All right, so
everybody,
here's the
over
thought. Did you
Windows.
guys hear? Did you guys hear what's happening with Sony right now?
No.
Sony,
So-
no.
Sony is going through a $7.6 billion lawsuit,
Okay.
and it has to do with a lot of their titles and their digital stuff. I can't remember the full details, but they're having to get rid of 1,200 titles. So anyone who has digital downloads, you only license those things.
Are you talking
Okay,
about like
so-
video games?
Video games, movies, shows. It's predominantly structured around shows right now, TV shows. So if you had digitally if we download a movie from Apple, we don't own that title like we do when we go out and physically buy the copy, right?
Oh,
So if Apple gets rid of it, we're fucked, right? And so there's this huge uproar right now in the industry right now, all the gamers saying, well, shit, if you're taking away stuff we have bought and you're not going to reimburse us on it, there's a class action lawsuit where you get like $500 at most.
Oh, geez.
I wonder if that's going to have an impact on going back to actually holding the hard copy, because that's the only way to
Never.
actually own it.
I don't know. And I would, you guys don't put a physical disc into your Xbox to play a
You
game
still
anymore,
can.
do
They
you?
make it that way.
Huh?
Up until recently, they've made it. They make both consoles, so where you can still do a hard disk or you can do just digital.
All right. Well, we'll ask Rogue Guy before we end the show whether it's a buy or sell. Bob, you don't drink coffee, you don't drink beer. I doubt you play fucking like Grand Theft Auto on the weekends, do you?
No, Papa Warbucks plays a lot of Call of Duty.
Oh,
Oh,
okay.
It
Shit.
was
Let's get your gamer tag
I
after
had
this.
2 kids in college. It's the only way I could communicate with them on a regular basis is by going out and blowing shit up. So
Yeah.
I'm not good. I'm saying I'm good.
Hey, Bob.
So-
And,
I don't
I'm,
think
I'm raising my hand because my kids laugh at me because I'm technologically challenged. But I had like all the hard discs like stacked up on my, next to my console. And I just bought the latest one digitally and it was a cluster. So
Brandon's got a hard disk. I don't think communicating with your son, I don't think that counts when you're on Call of Duty and you're like, get out of the way, motherfucker. Get out of the way. I'm going to shoot this guy. That's not exactly sharing your feelings.
I'm
say that
well
anymore
known for
anyways.
shooting my fellow teammates, which is not popular when they're a lot more serious than I am.
Oh, you're playing hardcore.
We're good at
I
that
like
stuff.
it.
Roby, you're with us. Buy or
For 30
sell on
seconds.
GameStop. Just let us know, because a lot of people got their finger on their trigger right now on their brokerage accounts.
I mean, I had an explanation, but I don't want my Wi-Fi to cut out. So I no, it's a sell. Yeah.
Well, Roby doesn't say sell often, but when he does, he gets it right. So I would lock that shit in right now. Lock it in. Or maybe you buy some options and fucking go against that thing, you know, like really go for it. Remember, on this show, this is investment advice. We do recommend it. And do what we tell you to do, okay? Don't be
Mark
stupid.
is a fucking fiduciary.
Do what the guy in the
Be
robe is
clear.
telling you to do.
I am a moron.
The new Jeannie Sutton bit. Okay, real quick. Fiduciary advocates. Bob, I mentioned earlier, you were a financial advisor, retirement plan advisor, ended up selling your business, and now you got a new gig going with your son. Everybody knows I love me some father-son business stuff. That's good. It's called Fiduciary Advocates, but it's a little different. It's not really something that we have in this industry, and I don't know whether that's good or bad. But do us a favor and let everyone know what it's about and what y'all are trying to do.
So Fiduciary Advocates, as JD said, I sold my practice back in 2019. I stayed with the firm that purchased us for a little over a year. Wasn't a great fit for me, and ended up leaving.
How many times EBITDA did you get?
Ooh, drink it up.
Based upon being a partner, I'm not allowed to discuss the
that's bullshit.
around the
Never get the
sale of the firm.
good information.
Nor am I allowed to discuss the firm. So moving on, we are. I stayed out of the business for a while. I know how much you love Vince Giovinazzo. I was a huge RPAG guy. Loved the group. They were a great partner for us. Came out. Oh, see there.
Retirement Plan Advisory Group.
And after a few months, I really missed the business. I mean, this I shared before. This is like among my people of retirement nerds. Missed the business. Didn't want to be an advisor again. I've been there, done that. And I went to a couple of conferences, and the thing I kept hearing over and over again is hiring the advisor is one of the most important decisions that the committee will make. And
Agreed.
Keeping that relationship is one of the most important decisions that they will make. But as a former advisor, we would tell our clients, you need to go out and vet us. I don't want you to talk to my competition. I don't want you to look at my fees, but you need to. There's no resources to do that. There's a couple of indexes, there's a couple, online things you can use, but there really wasn't any expertise around that. So I started talking to a couple of other advisors and said, hey, I'm thinking about getting out and helping plan sponsors vet their advisors, mostly through requests for proposals. The thinking that was the way it's usually done. And so we started looking at this, and a number of advisors said, it's an interesting concept, but it'll never work, and I would never buy into that. Ironically, one of them called me back like 2 weeks later and said, I hate you for this, but I've got a prospect. They need to make a change, and will you talk to him? I called the guy as a CFO who's new in the position. He said, I know our advisor's not good. I don't know how to go out and vet them. Will you help me? And
Chief Financial Officer.
I said, I've got no business card. I don't have a business. I've got a Gmail email address, but let's do this. And he said, great. That was our first engagement.
Those are the best kind of businesses, when there's a need for it, when you haven't even hung a shingle and you're helping someone figure something out.
So we started with the intention of being an independent resource for plan sponsors to vet their advisory relationship. And that ranges everything. We've really developed it into a two-step process. The first part of that process is your current advisor doing a good job? And we've done a number of projects where they wanted to vet their advisor. They were happy with their advisor, but they needed some documentation and due diligence around that. We came in, your fees are reasonable, your process is good. Here's a couple of enhancements you could make, and we move on. They document it. The advisor's happy. The plan sponsor's happy. It works really well. If that's not the case, hey, we're not happy, we want to make a change, then we go to phase two, which instead of being a request for proposal, which we don't like saying anymore, we call it a market comparison. So we will find qualified firms. and bring them to the plan sponsor and say, here's 4 or 5 firms that could do a good job. Do you want to look at pricing for all of them? We will go get pricing, bring them back, and do a fair comparison between those firms.
All right, someone who's in the know. Let me interrupt you for a second.
Sure.
Chad, do you feel guilty like I do sometimes that we have clients that are mid-size, large size? I mean, I can think of a few that are 5, 7, 10 million, kind of that small to medium, but slightly bigger client that maybe has an advisor who, by the way, I love this advisor. God bless him or her, because he or she brought me that plan as the third-party administrator. So I'm not talking shit, but they're not really good at being a retirement plan advisor. It's not kind of their jam. They do wealth management more, or health insurance or other things. And maybe the client's even happy. Maybe that person is responsive, answers emails, gets in there and kind of conducts meetings, but they're not a pro like many of the pros that we know and the people that kind of tune into the show from time to time. Does that client deserve better? And they don't even know what they don't know, right? They don't know what they could get from someone in terms of services. Does that concern you, Chad Johansson?
Yes. Yes, and it's the world we live in. And for years, I've said I rest easy at night knowing that we're involved and we're going to help get a good record keeper involved and set up a proper education program through that record keeper, because that advisor, in all likelihood, the analogy earlier in the chat bar, is a golf buddy or a church friend, and they're going to win the plan regardless.
But
So at least we can put some stopgaps in.
Okay,
Chad, if you got to dip, you can dip. Chad, go ahead, Bob.
I do. Go ahead, Bob. I want to hear
so
that.
here's so I appreciate that. And here is the challenge for us as an industry. That's the way things get done, especially on the smaller plan side. There's relationships, there's politics, there's all of those things. But at the end of the day, we all know that plan sponsor has fiduciary exposure in many cases, and they're not addressing it, and neither are you. So it is, and this is where it gets dicey. And for us, it gets dicey if everything that we have done so far has come either from an advisor or from a referral from a previous client. And
I got to run, Bob. But before I do, I just need to know, on these consultation cases that you're taking on, what's the average plan size?
We've done everything from 5 million. Our biggest plan so far has been 350 million. We're finalizing a deal on a $1.5 billion plan.
Your guess, it would be a more upmarket thing, right?
Yeah, that's exactly what I was getting at. My thought would have been somewhere in the range of 50 million or north.
Wait, if I understand Samson's comment,
here's the other thing that's been interesting. We originally started this to be an advocate for the plan sponsor because they are in many ways underserved by advisors who are not good or who are marginal. Now we're finding not only we're an advocate for them, we're an advocate for the qualified firms, because those firms that are out there who are really good and doing a great job and their fees are reasonable are competing against firms with shiny object marketing programs or financial wellness or whatever the catchphrase of the day is. And it's not a fair fight, especially if there's politics. And I've had 2 firms approach us because their CFOs get in touch with us and say, we can't change the advisor because they're a personal friend or acquaintance of the CEO. And these are good sized plans. And we need to, we need help on this. So here to your point earlier, JD, in that situation where there could be more services provided, here's what we recommended. We just finished a project where we had somebody who wanted to be included. We had somebody who wanted to be included who was not qualified on their own. And we said ahead of time, go partner with a firm that is qualified.
Fair enough.
And he came back in with a qualified plan advisor, and that made him much more viable.
First of all, let me just kind of logically back you up. Of course, I said this to you kind of in the pregame. We review our investments, or the plan sponsors review their investments. They review who their third-party administrator is. We know damn well they're supposed to benchmark their record keeper, their fees, all these types of things. And so, yeah, no offense to the advisor community, because it shouldn't be an offense, is you're also an integral part of that puzzle. Like you're probably the paramount piece to this whole thing. And so, yeah, you have to get reviewed too. And I think what you're saying is it doesn't have to be a bad thing. It can be a good thing. And it is a very difficult challenge. I've been in this position myself as a third-party administrator to try to review and vet yourself in front of your own clients. That's challenging, and it doesn't usually go over well. Much better to have an independent firm come in and say, yeah, no, JD's company's doing a decent job here. Their fees are prudent. They're a well-known, company in the industry. You've made a good choice. That's going to feel a lot better than JD telling them, oh, check out my brochure. We're fucking really good. And you should continue to work with us. So I think there is value, not just for the plan sponsor, but also for the advisor. Obviously you got headwinds against you. I think that can be a very intimidating thing to a lot of advisor shops to think like, well, shit, I don't want to be scrutinized or looked at. And so I challenge anyone who's reacting that way to think of it more like those other situations I discussed. And so with that, I think fiduciary advocates could be a great tool in our marketplace. So I wish you the best of luck. And if we want to act in the best, if we want our plan sponsors to act in the best interest of their plan participants, and we're here to support them in doing that, we need to be professionals and we need to do things well. And therefore, if you're somehow sitting out there thinking, geez, I don't want fiduciary advocates looking at how I service my clients and finding flaws or holes, well, then that's just saying to yourself, maybe you need to up your game a little bit and kind of figure out where you need to be better. And that's just going to benefit you in the long run. You'll make more money and be more successful if you kind of up your game and are up to the challenge of doing a good job. So anyways, fiduciary advocates, it's fiduciaryadvocates.io. I'll drink for that. And Bob and his son are running the show there. So reach out, inquire, get to know them a little bit. Bob is one of you. This is the biggest ad I've ever done for one of our people, right?
It actually is. Usually you forget to do any of this.
Bob is one of you, and he speaks your language, and you guys can I'm sure you'll hit it off. Our champion last week was Jim Sampson, a legend of the game, an icon of the game. I'm lazy. Last week when he won, I made the statement that I was just going to buy him a bunch of Big Macs. And so that's what I did. I just bought him a shit ton of Big Macs.
How many we get?
I think I said once. I think I said him 9 or 10 Big Macs and 8 Big Macs and an apple juice. I want to know. Originally, hey, did I make a bad decision? Originally, it was a medium cup of coffee, and I switched it to juice box. Should I have stayed with the coffee, or was the juice box better?
Are you asking us or him? Because I think you did the right job with the.
I'm asking you. You think juice box is better, Justin?
Yeah, right call. Yeah.
Okay, yeah. Good. I'm glad I made that switch.
Unequivocally, the juice box is better than coffee.
Okay. I thought 8 Big Macs and here's a
How
coffee
would you know?
to wash it down. Yeah, you don't even know what coffee tastes like, so you can't chime in on this. But you know what you can do, Bob, is you can let us know who is your vote for tonight's our champion.
Whoever just had the comment about mom meatloaf,
Devin, he works for us. Can't be him.
All right, sorry.
Devin can win, Justin.
Yeah, jeez.
Come on.
We don't pay him, so he's
my
got to get
brother-in-law is
something.
my advisor.
Devin can win. Nice.
Tony
I
too,
love
yeah.
your vote for one of our own. All right,
D.
Silent J, who's your vote for?
Oh, I gotta go. Oh, it's between Brashaw and Hack.
Okay.
Brashaw?
Yeah, Brashaw.
I gotta go Hack.
Okay, you're going Hackster. I love it. Brashaw cued me into a retirement plan advisory group YouTube video that's Bitcoin guy or something.
Yeah.
Go search it out. I went and looked at it. It's like 2 years old, but it was pretty good. Bitcoin guy. He's a dude in a Bitcoin t-shirt, and he walks into a fiduciary review meeting and kind of makes his pitch for why he should be included on the menu. But those nerds at RPEG, they turn him down, those fucking dipshits. Roby, your vote.
Tony Davis.
Who?
Tony.
Okay.
Yeah.
Tony
Yeah,
Davis
good
back
too.
in the action. These are kind of stellars here. We got Haxter, we got Devin, we got Tony Davis. I'm going to make this difficult. I'm going with Samson again, because just because he won last time and just because he's won a lot before doesn't mean he should be overlooked. You should look at the quality of his chat bar game, and it was solid. And maybe he wants more Big Macs.
I'm sure the answer is no, but do we keep a tally of these anywhere listed?
I thought Hackler was going to work on a tally for us. Maybe we could ask artificial intelligence to review the 200 episodes and tell us that'd be a good task. You know how this works, Rob guy? You're going to give them a sentence, and then they have to finish that sentence in the chat bar. Other people can play.
Yeah, I think this goes along with our theme today for the first half of our show, which took up too much time as always. But in the realm of Bitcoin,
you're good, Mark. We can hear you.
Okay, all right. Yeah. I might cut out here soon. If for the four of you, if you were designing and rolling out your own cryptocurrency, what would it be called?
What would your cryptocurrency be called? I like this, Roby.
How does your brain work like that? That's impressive.
Bob, well, they try to come up with their answers. Mark, I want to say thank you for spending some time with us tonight on Retireholics. Thank you for being a retirement plan lifer and stud. It's great to have you as part of our circle now. And I'll do my best to continue to share the story of Fiduciary Advocates. And it'll be fun to watch how you guys succeed. And I love the father-son aspect. So we'll see how that goes. Hackler, who's in this final right now, he's a father-son guy. Brashaw, Arissa coin. It's worth 1974. Oh, that's when it started. I forgot to say that. Happy birthday to Arissa next year for 50 years, I believe.
Wait, why did he say something? Did someone else vote for him?
No, everybody can say something, but he's not a part of the competition.
All right. I thought who voted for Brashaw? Oh no,
nobody did. I got Hackler.
Yeah, you hacked him. Oh, you could have won, Brashaw. Too bad. Hackalicious is the name of your coin. I don't know about that.
Sounds like a Dogecoin.
Hackalicious.
Well, Tony Davis said fucking chat coin, dude. Okay.
This is and he's claiming he wins with Chatcoin. I don't know, Tony. It's better than.
So it's just Chatcoin. Got it.
Yeah,
Okay.
Chatcoin.
Oh, okay. Chatcoin.
Who else are we waiting on?
I didn't see anything from.
401 coin with a K.
Who did that?
Me.
Oh.
Put it in there.
Devins is Genghis Khan. The youth these days. That's not a good.
Is that a play on word, like a con? Like Bitcoin's a con?
I don't know, but I don't not vote.
All right, so wait, is Samson's answer hack sucks?
Call it hack sucks. It's empty, full of shit, and wins every time.
That wins. That has to win.
Okay, I'm not sure we've done this before. I think maybe we have, but we have a back-to-back chat bar champion. Jim Sampson, call it hack sucks. It's empty, full of shit, and wins every time. Congratulations, Hack. Next time we'll send you 8 Whoppers. No. Thank you, Bob, again to you and Fiduciary Advocates, and thanks to Roby. I love you, buddy. Justin, I'm sorry for opening your mail without asking you. I can look at your mail.
Now we have evidence of it.
I forgot that other guy who was on the show that left early. I don't remember his name. Brandon, appreciate your efforts in producing. There's Chad. There's Chad. And thanks to all you out there for tuning in, whether live on Thursday night or you're just strolling through YouTube and you watch the show. I like you, man. I like you, woman. You're a 401k pro, or you're going to be someday. We're the Retireholics. We're changing the retirement plan industry one beer at a time. Brandon, play some fucking music.